Hello and welcome to the show. Great to have you with us. For months now, whether it comes in a tweet or an official statement, every time the U.S. and China say anything about the trade war, the market would swing wildly up or down. My next guest says while the markets are preoccupied with the day-to-day trade war drama, investors could be overlooking some long-term opportunities. Joining me now is Haining Zha. He's Vice President and Portfolio Manager at TD Asset Management. It is great to have you here.
My pleasure.
I know that you have a lot of insight in terms of what's happening with China right now, but just before we get into the longer-term opportunity you're talking about, just maybe bring us up to speed on what the latest is with the trade skirmish between China and the U.S.
Sure, maybe I can start with some facts. So assuming there is no further progress in the trade negotiation by the end of December, all of the scope of the tariff will pretty much cover all of the bilateral trade between U.S. and China. So that's a clear negative. But on the other hand, we also think that the true economic impact from the trade war might be exaggerated due to a range of factors. For example, the central bank policy as well as exchange rate movement. So nothing to panic about.
Okay, so if it's nothing to panic about in terms of the market reaction, what do you think we should be looking at when we look at the opportunity out of China?
Yeah, we believe investors should also look at the long-term pictures. Unfortunately, what we found is that as investors are increasingly driven by the day-to-day market headlines, they are actually ignoring some of the long-term tailwinds for Chinese equities right now.
What are those tailwinds?
For example, the first thing we want to highlight is the equity risk premium. So in simple terms, equity risk premium is basically the gap between the equity return and the fixed income return. So that gap needs to be high to attract investor into the equity. And for Chinese equity, that particular measure is at a pretty high level right now.
Second tailwind I know you're looking at is, and this is interesting, is just also the quality of the types of companies that are currently listed in China.
Yeah, that's the second tailwind. So that's the gradual improvement in companies' quality because of more transparent and stringent regulators and also the regulatory measures. To give you some numbers, starting from early 1990s till 2018, in those 28 years of time, there are only 100 or so companies got delisted in Asia. But in Asia, there are a good number of zombie companies out there.
And what are zombie companies, just to remind people?
I.e., they are losing money, they are not focused on creating value for the shareholders.
But they're publicly traded?
But they are publicly traded.
Got it. Okay, continue. Sorry.
And things started changing. At the end of last year, there are a lot more regulatory requirements, and the regulators start cleansing the whole system. And so far in 2018, there are already 5 companies delisted and 17 companies pending delisting. And there are about another 80 companies that are hovering around the borderline. So we can see regulators are taking more and more measures to address those issues.
Now, you're saying that is a positive in terms of that's a tailwind to look at, but is that not also a bit of a negative? I mean, if I'm listening to you, I'm saying, hey, wait, there's a lot of maybe bad quality companies that we have to be careful of. So is it a short-term negative, maybe a long-term positive, or help me understand that?
Absolutely, and that's people's natural reaction. In the short term, it will increase people's risk aversion, it will impact market sentiment, but in the long run, that's the most positive thing that can happen because capital allocation is the key mechanism of an efficient economy.
I know that you've got a number here that we're going to bring up, and I'm going to just tell people what it is. 10 years, we're going to bring up this board, and this is because this is the potential you see for the Chinese economy.
Yeah, 10 years. I don't think many people realize that, but according to the growth projection, in 10 years' time, China will be an economy almost as big as the U.S. So that will have a huge impact in the investment world. So think about how much we invest in Chinese equity today versus China's future weight in the global economy. There is a huge gap, and somehow this gap needs to be filled.
So, and do you see, investors awakening to that opportunity in the next little while? So this isn't just about the economic story. This is about the investment story of maybe the accessibility to those markets as well as the cleanliness of that market, you're saying, at the same time.
Yeah, actually, we are seeing the sign actually starting from this year, and partly because of Asia is gradually getting included into the major index, there are more and more foreign capital flow into the China market.
Just to play devil's advocate, what are some of the headwinds, I think, that face the Chinese economy in the next little while? Because these are good tailwinds, but obviously a trade war is one.
Yeah, and I think all of the major risks are pretty well known and pretty well priced into the market. For example, the first one would come to my mind would be the debt, and another one would be high property price. But all of these factors are already well priced into the market.
Haining, a pleasure. Will you come back and visit?
Thank you.
Haining Zha, he's Vice President of TD Asset Management, and enjoying our talk and always taking a close look at China.